Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am here with our host, Robb Fahrion, the CEO and founder of Flying V, our digital marketing partner. Robb, thanks so much for joining us on Easter. Happy Easter. How you doing?
Happy Easter, Gary. Happy Sunday. Really excited for this episode with our guest who will introduce shortly. Big fan of his, but yeah, I'm doing well. How are you?
Good, good. Busy week. We had some very exciting news for DKI subscribers this week. We'll be talking about that, and I'm excited to introduce our guest. Anything you want to mention at the beginning, Robb, or should we get going?
We're talking in this issue, we're naming it the Shockwave issue. So I'm sure if you've been following DKI, we're going to have tons on that here a little bit later. We're talking PCE. We're talking technical trading, technical indicators, Nvidia, as well as consumer confidence. Gary, I'll let us get into what I think is the most exciting part of the show and introducing our guest.
Here we go. So excited to be talking today with somebody who contributed one of our 5 things this week, Enrique Abeyta from HX Research. Enrique, how are you today?
I'm good. I'm good. Grinding away here on a Sunday.
Good. Well, thanks for joining us. One of the reasons I'm excited to be talking to you is DKI exclusively focuses on fundamental research and macro. You have made a lot of money based on technicals. And so I think for you, it's been predictive. Let's talk about what you have on your mind right now.
Yeah. Well, look, I think I employ what Steve Cohen called a mosaic approach, right? Which is we spend the majority of our time also in fundamentals, whether that be company fundamentals or macro fundamentals, but we utilize technicals to optimize our investment strategies, whether those are trading or investing strategies. So what I was excited to talk to you about this week is, there's a very, very rare technical signal that's just came up, and it's very, very powerful. Now, let me be clear. What do I mean when I say technicals? Technicals basically means the analysis of past price and other data. Generally, volume would be the other piece in there, and other derivations of price, including volatility, things you can calculate like RSI, et cetera. And the idea is that we can never know the balance of buyers and sellers and what everyone thinks and what their emotions are, this incredibly complex organism that is the stock market. But price is truth. Price tells us where the market is. And so what happens is sometimes in the market, we see trends that can tell us what is going to happen next. And the way I explain this is, I love talking about blackjack. I write a lot about that. I grew up in Arizona. My parents met in Reno. My mom was a cigarette girl. My dad, his last 20 years, was a professional gambler. And, the thing about blackjack, if you've read, and there's a couple blackjack books on my bookshelf back here, if you've ever read about how to play good blackjack, and I'm not even talking about counting cards, but let's go to counting cards, is you never know that you're going to win any hand no matter what you see with the cards, but the probability increases, okay? So what we like to do in our trading strategies and with a lot of our strategies is you could have the best thesis in the world, the best idea, et cetera, and you're still going to lose. Something's going to happen. That's the nature of reality. That's the nature of the stock market. But you can bend probabilities, or you can identify situations where probabilities are in your favor. And so what's happening right now is we just completed the month of March. March was up. I'm going to pull it up here in my Bloomberg. Give me 1 second. Let me get the final number. But March was the 5th month in a row where the stock market was up. The S&P 500 was up more than 1%. Okay, so 5 months in a row of 1% or greater performance. So by the way, the S&P for the month was up 3.10. So it did a hell of a lot better than up 1. Now, that occurrence, 5 months in a row of plus 1% or more in the S&P 500, has only happened 12 times in the last 75 years. Okay. Now, what I'm interested in, the reason that this is predictive of potential probabilities is that when you have something happen only 12 times in 75 years, that means that there's a unique set of circumstances and they probably share a lot of commonality. So what's interesting to look at is what happened next, okay? In the following month, after those 12 previous times, what happened was the stock market was up only about 60% of the time. Now, I'm going to tell you that's actually greater than any random month. The stock market's up 54% of the time normally. But when you go out 6 and 12 months, 11 out of 12, the stock market was higher 6 months later. 12 out of 12, it was higher. 12 out of 12, it was higher 12 months later. That was a lot of 12s. And the performance of the market in the 6 months was 35% greater than a normal 6-month forward performance and 50% greater in a normal 12-month performance. So this is the blackjack. And again, I apologize if some people don't follow blackjack, but this is the equivalent in counting cards of the dealer having, dealt out all the small cards and you're sitting with a bunch of face cards. And so, look, this doesn't mean the S&P 500 will be higher 6 and 12 months later. It's not a guarantee. There's no guarantee that it'll also be higher on average more than what it normally does. But I got to tell you, your odds are pretty good. So what we do, and I'll kind of finish with this is part of our mosaic. It doesn't mean we go from being bearish to being bullish or we're going to make some big bets on this. But when we're putting our mosaic to understand both our trading and investing strategies, because we have both, this is another piece that goes in the mosaic. And this is a unique, like I said, this has happened 12 times in my 30-year career. I think it's happened 6. And this might only be the 3rd time I've actually been paying attention to it. So it's a pretty rare occurrence and worth highlighting.
That's a great explanation. For some of the people who aren't constantly working in finance, let's unravel a couple of the terms Enrique brought up. He talked about probability analysis, and that's a key part of not only how gamblers approach managing their cash flow, their money, but also how investors think about things. So let's just take 2 examples, right? Let's imagine a scenario where you have a stock where you think there's a 50% probability that you lose all your money and a 50% probability that you make 10 times your money. You would put that on. You would put that trade on. You'd make that bet. Let's give another example. Let's say there's another stock where you think there's a 90% probability that you make 20% and a 10% probability that you lose 20%, right? So your upside and downside are the same, but the probability of making money is higher. You would do that, right? So that's what he's talking about. Where are the situations where you want to have more money invested and the situations where maybe you'd either invest less or stay away from it. So Enrique, based on the strength of this particular indicator, which, as you pointed out, comes up once or twice a decade and has been predictive 100% of the time, how does that affect how you're changing or setting up your market exposure right now?
Well, our products are very disciplined. Again, we have trading and investing products. Both styles are made to make money in any market. Our trading strategy, HX Trader, in 2022 had 74 recommendations. They were all long, so we didn't do a single non-long, didn't do any short ETFs, and we were up 9% on an absolute basis. So I build my portfolios to perform in all markets. I will say this, we were already constructive, but, I don't know, maybe I'll be a little bit more aggressive in buying the dip, when the inevitable dips come, because we do think some corrections make sense at some point. But again, it's just one of the pieces of the mosaic. So I don't know, how would I say this? I'm still sailing the ship the same direction and in the same way, but maybe at moments in time, as the winds and waves hit that boat, I may react slightly different than I would normally. So it's a small piece of the mosaic, but it may present some real great money-making opportunities.
One thing we've talked about a lot on this program that I think is a tailwind for you is just massive amounts of governmental overspending. One, that's trillions of dollars of additional stimulus hitting the economy, which will be positive for the stock market, right? That they blow up asset bubbles. And then the second thing that I would add to that is all of that spending creates more inflation. And, high inflation can also potentially lead to higher stock prices, depending on the timing of what the Federal Reserve does. Any thoughts on that?
Yeah, look, I think the macro backdrop is fundamentally constructive. I mean, rates are higher, but they're not actually high. Inflation is higher, but a lot lower than it was and not actually high. And one other piece of data that I saw recently, I think this was from Bespoke Investment Group, was that it is statistically significant that the Federal Reserve is less active during presidential election years. Like, it stands out. It's materially, when you look at the data. And so I kind of think we're in a market where the Fed's just not going to do very much because they don't want to be viewed as being political. Although I do think they have political tinges to it. So look, we of course we could have a war. We could have a COVID, we could have kind of anomalous exogenous factors that we can't predict. But I'll tell you, we just had a whole bunch of those and we've kind of been shaking them off. So, look, most of the time the market goes up. Bull trends persist for, 30, 40, 50 months. I'm not telling people to go out and lever up into this, but the trend is your friend during certain periods. And, I think you should constructively and tactically take advantage of it.
Makes sense. All right. Thanks so much, Enrique. For people who are interested in what you're doing and see the value of the great research and money-making stock picking you're doing, how can they find you?
Well, we have a free daily email, which is the HX Daily. That's at daily.hxresearch. H is in Henry, X is in X-ray. Daily.hxresearch.net. And you can follow me at Enrique Abeyta, one word, on X Twitter.
Sounds good. We'll put the link in the description so it's easy for people. Thanks so much for joining us today. We really appreciate it.
Appreciate it.
Thanks so much, Enrique. Fascinating there, Gary. Thanks for getting Enrique on here. That was awesome. We did miss the title of the thing. So it was Enrique Abeyta illustrates a technical indicator with a perfect record. So be sure to check that out in the written 5 things. Gary, question for you. You mentioned, foundational fundamental trading versus technical, right? And where you focus. How do you come about that? Is it just personal preference? Just curious on your take on that.
So the people who use technical trading, to their credit, the people who do it well make money doing it. The reason I don't focus on it is because very often there is no, some of the indicators may be predictive, but you don't necessarily know why, right? It's not like there's a story where you can say, because the chart looks like this, I think that's going to happen. It's by definition backwards looking. And as a fundamental analyst, I like to be forward looking. Now, I think the people who use it really well are the people who use fundamental analysis to figure out, wait a minute, this is a stock I really want to own. And then they'll use technicals to figure out maybe their entry and exit points. And that can be effective. With that said, so much of the investing we're doing at Deep Knowledge Investing, we're really aiming for high returns. At a minimum, I'm looking for things that will make 25 to 40% in, maybe a year or two. And we've had a bunch of stock picks and positions that have gone up more than 100%. And so in situations like that, I don't necessarily worry so much about getting the exact right entry point. It really is more about, can we make a ton of money in this in a year, 2 years, 5 years, something like that? And so, people have different strategies on it. The key thing is to know what you're doing and why, and be consistent in your methodology.
Makes tons of sense. Okay, getting back to regular scheduling on the 5 things, we're going to jump into thing number 1 on your written sheet, 2 for the video version. The PCE is as expected, Gary.
Yeah, so the PCE stands for the Personal Consumption Expenditures Index. And the reason it's the preferred measure that the Federal Reserve looks at to figure out inflation is it's a closer measure for people's actual spending. The CPI, the Consumer Price Index, it's basically a basket, but it's so managed and so manipulated that it doesn't really measure anyone's particular spending. The PCE is more tied to people's personal spending and is maybe a more accurate way of figuring out whether people's expenses are going up or down. This month, the PCE was up 2.5%, and the core PCE, that's the number that excludes food and energy, was up 2.8%. Now, what's really interesting about this is the Bulls and the Bears, the Hawks and the Doves, both claimed victory on this one. So the Doves, who want to see the Federal Reserve go to lower interest rates, shift to lower interest rates, they said, hey, this is terrific. the PCE is down, inflation is subsiding. We have disinflation, which we keep talking about as a reduction in the rate of inflation. And they're like, hey, this is terrific. We have a win here. The hawks, who favor higher interest rates, were saying, not so fast here. First of all, you did have one of the indexes go down 0.1%. The other was up 0.1%. That is not really getting better. And the other thing is you had the PCE was really up 0.3% for the month. Now, again, we've talked about this before, really, really easy for people to say, well, 0.3%, why is that a big deal, right? Like on a $100 purchase, what is it, another 30 cents? Why does that matter? And the reason it matters is because it's month over month. And if you annualize a 0.3% increase month over month, you end up with, I want to say 3.7%, something like that. Yeah. So when that annualizes at 3.7%, that's almost double the Fed's target. And that's a huge problem.
So it looks like, Gary, both sides, hawks, doves, kind of using this data to validate or say that they are right. Are you a hawk or a dove? I think I know the answer to this question, but what's your take?
So here's the thing. I don't have, I don't have, my business doesn't depend on one or the other. Right now, what we're seeing a lot of people is a lot of people who are asset gatherers, right? People who they just want the market to go up because then they're managing more money and they take, a 0.5% fee or 1% fee or some fee based on assets. If asset prices go up, they get paid more. And they're saying we want lower interest rates to blow up a giant bubble. I think that's a bad idea. I don't have money one way or another. I think we do have a huge inflation problem. I think CPI and inflation is understated. And we've talked about this before. I think massive government overspending is going to lead to more inflation. The Fed doesn't have this under control yet. And again, another thing we've talked about regularly is that everything the Federal Reserve is doing, Congress with its overspending and the Treasury Department by monetizing that, by adding to the debt, is undoing. And so one part of the government is trying to bring inflation down. The other is pursuing policies which will increase inflation. To that extent, I actually think Powell and the Fed have made the right decision to not lower rates yet. That puts me in the hawk camp. I don't identify as one or the other, but I do think they shouldn't be. I do think they shouldn't be lowering interest rates right now. So, here we are. I guess I'm on the hawk side at the moment.
Sounds good. Gary, thing number 3, as we talked about earlier, the title of the issue, the Shockwave issue. Here we get into Shockwave now. Shockwave Medical, ticker SWAV, gets approached again.
Yeah, so this was a huge win for Deep Knowledge Investing and our subscribers. I recommended the stock to our subscribers in December, so about 3.5 months ago when it was at 190. And what had happened was about a year ago, the company was approached by Boston Scientific and they wanted to take the company over for $285 a share. That didn't happen. The stock cratered. And what we realized is that Shockwave makes a best-in-class device that enables placement of a stent where arteries are calcified. There's hardening of the arteries, and that can make placement of a normal stent difficult, impossible, or dangerous. And prior to Shockwave, the best standard of care was something called a rotablator, which is like almost like a drill or a blender on a thin wire. And so they'd run this wire through the artery, get to the part that's calcified, start the blender, start the drill, and drill through. And that procedure has 2 problems. One is it's very risky, because if the surgeon misses by just a little bit and nicks the wall of the artery and perforates the artery or opens up an opening in that artery, the patient can die on the operating table. They can bleed out and die within minutes. It is a crucial, critical procedure. The other problem is, let's say that device is used properly. What will happen is the rotablator will remove the plaque in the middle of the artery, but it can't get the stuff that's at the edge of the artery, again, without nicking it. And because of that, you can have a stent harden around, the artery harden around a stent, and that can lead to long-term problems. It's not particularly safe. Shockwave, what it has is they've got a device that goes into the middle of that artery and uses electrical pulses to break up the plaque. It's actually based on old technology. It's what they've used for 30 years to break up kidney stones. But Shockwave is the only company in the world that has the equipment and the procedure to do it within a coronary artery. And what that does is it safely removes the plaque and also removes the plaque from the artery wall. And so there is no company in the world that has better equipment for these difficult procedures than Shockwave. And the company growth has been phenomenal. I think last quarter it was more than 40% revenue growth. There's room to grow in the international markets and room to grow into peripherals, which is just a fancy way of saying procedures that involve blockages in arteries that go to the arms and legs. So here's what happened. When we initiated on the company at 190, we said, hey, you know, this company is going to be bought. There's no way in the world that they remain a separately managed enterprise in the future. And last week, Johnson & Johnson announced they were in takeover talks with Shockwave, and the stock closed on Friday, I think at 325, up more than 70% in under 4 months. That was a huge win for DKI subscribers.
So Gary, let's hypothetically say, you know, you got Johnson & Johnson. I think in the past, Boston was in the mix as well. Sounds like they're obviously in talks. Let's just say hypothetically these talks are, or these acquisitions are rejected, right? What does that mean to you? Does it adjust what you do with the position moving forward? What does that tell you?
Yeah, so the upside here is what we'd love to see is Boston Scientific or Medtronic come in and bid, and then you have a bidding war. And when that happens, the price can go up huge. But let's say, you know, in this hypothetical case, Boston Scientific and Medtronic don't come in. And, you know, let's say the stock is trading right around, you know, where Johnson & Johnson is bidding, call it 325, 330, something like that. And management rejects it. So what we would have had in this hypothetical situation is management rejecting an offer from Boston Scientific at 285 last year, an offer from Johnson & Johnson this year at more than 300. Here's the thing. If you are a management team and you reject that offer, you better have a lot of confidence in your near-term results. Because if you reject a takeover offer from a larger competitor and then post really lousy results, you're going to lose your job. You're going to be sued. There will be shareholder lawsuits. You're going to spend the next year involved in litigation and, you know, probably lose your job. And that's not why these guys are doing this. It's also worth pointing out that management has sold a lot of stock. Now, some people might say, wait, that's a concern. But management also owns a ton of stock. The CEO in this case owns, you know, close to $100 million of stock in this company. So he's incentivized to do the right thing for shareholders. But a situation where company management sells stock into the market at a low level, but doesn't give public shareholders the takeout multiple, there's a 100% probability you get sued. So if they reject a deal here for the second time in 2 years, you have to figure they know everything I've just said, and they would have an enormous amount of confidence in their near-term results. And if I were one of the sell-side analysts following the company and they reject the offer, the first thing I would do is take up short-term estimates, right? I'd be raising revenue and earnings estimates for the quarter and for the year just on that, because again, otherwise management's going to be sued.
Right. Great. Moving to thing number 4, Gary, and Gary, congratulations too on that call initially. I mean, in what, you said December, 3 short months to, just an incredible run that we've seen there. So don't want to move forward before I do say that. So it's very exciting.
Let me add one other thing that's really important here. This was a team effort. Dr. Paul Thompson is one of the country's top exercise cardiologists. He's on the Deep Knowledge Investing Board of Advisors. He was the one who knew about this. He was the one who called me, presented the idea. And then when I was working on the research for it, got me in touch with Dr. Dan Fram, who's one of the top interventional cardiologists in the Northeast. So, you know, I've got guys on the board who are bringing me these unbelievable ideas and helping me do the research. And Dr. Thompson and Dr. Fram did a webinar with DKI subscribers where they spent an hour actually going through the medical device and the medical procedure and talking and explaining to people, lay people, exactly how this stuff works and why the Shockwave solution is better. It was just a remarkable way to get an idea and explore an idea and understand it in a way that a lot of people wouldn't. And so, I want to thank these terrific cardiologists and the DKI board of advisors who have, helped us just put up unbelievable returns here.
Definitely. Yeah. And if you're interested in getting access to those webinars like we're talking about, and obviously Gary's deep dives into these new positions that are coming online, be sure to subscribe as a premium subscriber. You'll get all of those notifications and access to board of advisors, as well as doctors like Dan Fram and so forth, with positions like Shockwave. Moving to thing number 4, we're talking Nvidia again, NVDA. Nvidia suffers its first loss of the year. Might need a little disclaimer there, Gary.
Yeah. All right. So everyone, I apologize. It's a clickbait title. Nvidia didn't really lose. But here's what happened. Samsung did get a $750 million order pulled away from Nvidia. There's a Korean company called Naver, and there were two things going on. One, Naver wanted to ensure they have more than one supplier. And there have been reports in the Wall Street Journal this year about how companies are intentionally over ordering from Nvidia because they're just the one supplier of these GPUs, the graphics processing units, the chips that are so valuable for AI, artificial intelligence processing. And Nvidia is without question the market leader, but companies right now are over ordering because they're afraid to not stay in Nvidia's good graces. Because if they want to order and Nvidia says, yeah, we're going to allocate these chips to somebody else, these companies could have a problem. So Naver intelligently said, you know what, we'd really like to have more than one supplier. We'd like to not be completely dependent on Nvidia. That's part of it. The other thing is there are some people who think that Samsung's Mach 1 chip, that's the chip that's involved here, has some advantages over Nvidia's chips. Nobody is claiming that Samsung's chips are better than Nvidia for everything, or that Nvidia doesn't have the best GPUs in the business. As of today, they 100% do. But there are certain applications where, you might prefer a specialized chip. And, Samsung is a fantastic chip maker. They're a fantastic hardware maker. They've already started making cell phones with onboard AI capabilities. And so, is $750 million going to, shut down Nvidia? Not even close. But it is a situation where, you follow it because, it's close to $1 billion order. It's meaningful. And it's, the first time we've seen Nvidia not win something head to head in quite a long time.
So we know Nvidia obviously has a lead in the space with technology, right? No lead's ever safe, I would say. Like, who would you say, who or what, what is really the biggest threat to Nvidia, if any?
Well, right now, they are without question the market leader in the hottest area of the market, right? GPUs for artificial intelligence. With that said, there are a lot of companies taking aim at this. AMD is trying to produce chips that will compete. We just saw Samsung do it. Do I know 5 years from now what kind of ground these companies will have made up, or, who's going to be close to Nvidia then, or, will they be overtaken? That's really hard to predict. The only thing that I'm comfortable saying at this point is I don't think it's realistic to assume that anybody will maintain a lead in technology hardware forever. And I don't think Nvidia is going to have the GPU/AI market to themselves forever. There is competition coming. They're extremely well equipped to deal with it. If you take a look at the processing capability of Nvidia's best chips, it's been much faster than Moore's law, which states that processing power typically doubles every 18 months or so. Nvidia's progress is much better than that. They're doing an amazing job. Just again, in technology, nobody's able to maintain that kind of lead and market dominance and really just stand alone in this market forever. It's going to be competitive.
Great. Wrapping up on this week's version of the 5 things, this Shockwave issue, we have thing number 5, consumer confidence versus expectations, Gary.
Yeah, so there's a group called the Conference Board, and every month they report consumer confidence. And, one of the things that always makes me laugh, a lot of times these indexes get revised later on. Like, what do? They go back and ask people, are you sure? I'm not exactly sure how these things get revised, but the consumer confidence index for March came in at 104.7. Okay, so everybody's wondering, is that good? Is that bad? It's a fine number. It's roughly the same as last month's 104.8, and it's in line with where we've been, and it's a healthy number. When you see a number around 105, nothing's wrong with that. Okay, so what's the problem? The issue is the forward-looking index, the expectations index. And they ask people, what are your expectations, your outlook for income, for business, for labor conditions? That was a different story. That fell from 76.3 the prior month to 73.8 this month. Is that a big decline? No, but here's the issue. It's going in the wrong direction, and anything under 80 signals a potential recession. And that's why, people were a little bit concerned about it. So it was a bit of a mixed bag. The current number was all right. The expectations number was signaling a problem.
So we've been seeing, Gary, a lot of articles, mainstream media calling out kind of that lack of enthusiasm, I think, for the economy. Seems like certain experts thinks that the American people are out of touch, but why do you think the experts actually might be out of touch, and what can they do to be more in touch with, I think, what you're seeing with the average American?
Yeah, so you've got 330 million Americans saying we're really concerned about the economy. We're not happy. We're really worried. And then you have, a couple dozen economists and journalists saying, why aren't people more grateful for the great economy we have? So what's going on here? First of all, let's unravel motivations. And for people listening, I don't care which side of the political aisle you're on. We're just talking about people's motivations. The press in this case leans very hard to the left, and they'd like to see the White House not change hands. They don't want to see President Trump back in the White House next year. Okay, we understand that. So Americans tend to vote based on the economy. That is the most reliable indicator of who's going to win the election. And so they're saying, wait, we have a great economy. Look at this number and this number. The unemployment number is low and inflation's coming down. And why aren't people more grateful? Okay, that is cheerleading. And that's fine, right? If you don't want to see the White House change hands, that's totally fine. You're entitled to that opinion, and you're entitled to cheerlead for your side. But that doesn't mean that 330 million Americans are wrong about the economy. So let's talk about the reasons, right? One, we talk about the low unemployment rate, the high employment numbers. Well, yeah, that's true. But the real issue is we haven't had an increase in full-time employment in this country in years. All of the growth has been in additional part-time jobs. So what we have is it's not more people working, it's the same people working more. They're taking on second and third jobs, and that counts as more employment. That's okay, but more people working more part-time jobs is not indicative of a healthy economy. People don't take on second and third jobs because everything's okay at home. The other thing that I would focus on is the media likes to focus on disinflation. Again, that's a decrease in the rate of inflation, but real people live off of price levels. So, if your grocery bill went up last year by 20% and this year it's only up by 5%, the media telling you, hey, things are getting better. No, people are still facing sticker shock when they go to the supermarket. And the CPI, the Consumer Price Index, keeps trying to tell us that food inflation is only 2%. Again, I've yet to find anyone who believes that number, and I'm convinced anybody who thinks that food inflation is only 2% hasn't been in a supermarket in years. People are having more difficulty balancing their household budgets. Inflation is worse than they're being told it is. Price levels remain high after a couple of years of very high inflation, and the employment numbers are technically accurate but misleading. So I think people are struggling right now, and they're having a tough time, and they're recognizing that. And if 330 Americans are telling you we're concerned, we're worried, we don't feel secure at home, we don't feel secure in our jobs, we're living paycheck to paycheck, the experts should be listening to these people instead of telling them, no, you're all wrong, the economy's great. We have statistics from the Bureau of Labor Statistics that prove otherwise. They prove you all wrong. That's a bad approach, and I don't think it's going to be effective.
Great, Gary. Thank you so much on this Easter Sunday for this week's versions of the 5 things. Thank you for getting Enrique on. Awesome guests, as we've always had our past guests as well. If you're interested in subscribing to Deep Knowledge Investing, go to our website. There's a free option to sign up for our free version of the newsletter. Please subscribe to our YouTube channel where you'll see this version in full, as well as smaller, short clips of the different topics that we're discussing. And as always, if you'd consider signing up for a premium subscription of Deep Knowledge Investing, that'll give you access to all current recommendations, premium content, webinars, the whole 9 yards, and definitely huge value in everything that Gary and the Deep Knowledge Investing team is providing from a research perspective. Gary, thanks so much for your time as always. Any closing thoughts that you might have?
Yeah, Rob, thanks as always for doing this with me and for spending your Easter with Enrique and me. We really appreciate it. For the people watching this, thanks so much. I know your time is valuable and we appreciate you spending it with us. And I just want to, give a special thanks again to Dr. Paul Thompson, Dr. Dan Fram, cardiologist, who helped Deep Knowledge Investing subscribers make, 70% in 3.5 months. That is absolutely fantastic. And to the Deep Knowledge Investing Board of Advisors, thanks so much. I really appreciate all you've done for me, for the firm, and for our subscribers, which is why we're all here. Thanks to all of you.
Thanks so